Hello and welcome to this webcast on IFRS 16. This is the fourth in a series of webcasts following the recent publication of the new Leases standard. Today we'll be talking about the two optional recognition exemptions for lessees in IFRS 16. These relate to short-term leases and leases of low-value assets. I'm Catherine Donkersley and I'm joined today by Board Member Sue Lloyd. Just to note before we start that, as always, the views presented in this webcast are those of myself and Sue and don't necessarily represent the views of the Board or the IFRS Foundation. This slide summarises what we'll be talking about today. The webcast will be split into three parts. First, I'll talk briefly about how a lessee should account for those leases to which one of the optional recognition exemptions in IFRS 16 is applied. We'll then move on to talk about the two exemptions. Firstly, short-term leases, and then leases of low-value assets. The way we'll run this webcast is that for each exemption, I'll summarise the requirements in IFRS 16 and then ask Sue to talk about how the Board arrived at those requirements and the kinds of leases that the Board intended to be captured by the exemption. This part of the webcast is intended to provide useful context for listeners when they're looking to apply the exemptions in practice. The recognition exemptions are one of the areas where the Board has received a number of questions from those currently working on the implementation of IFRS 16. So as we talk through each exemption, we'll also look at the implementation questions we've heard people talking about so far. Now, before we move on to the detail, perhaps I could come to you, Sue, and ask you to talk briefly about why the Board decided to permit any exemptions at all. That might give some useful context for listeners for the rest of the webcast.
Okay, sure. The underlying reason for both exemptions was really one of costs and benefits. Basically, we were trying to be pragmatic. During the course of the project, we learned that generally speaking, leases fall into two broad camps. Companies typically have a smaller number of high-value leases, such as real estate or large equipment leases, and high volumes of lower-value leases, such as for their office equipment. We heard many concerns from lessees about the costs of applying the new standard, in particular to these high volumes of low-value leases. Cost is only one side of it, of course, so we also talked to many investors and analysts about their information needs and thought about how best to provide cost relief to lessees without substantially compromising the usefulness of the information that would be presented to the users of the financial statements. We considered many options and ultimately the two recognition exemptions that are in IFRS 16 represent what we thought was the best solution to provide a balance between providing cost relief to lessees and maintaining the benefits of improved information for the users of financial statements.
Thanks, Sue. So first I'll summarise how a lessee should account for a lease to which it applies either of the two exemptions. IFRS 16 requires a lessee to treat these leases similarly to IAS 17 operating leases. In other words, assets and liabilities wouldn't be recognised on the balance sheet, with the exception of any prepaid and accrued lease payments. Instead, a lessee recognises a P&L rent expense over the life of the lease, which would typically be recognised on a straight-line basis. This accounting treatment will be familiar to those with operating leases today. For exempt leases, there are also some disclosure requirements. In particular, IFRS 16 requires a lessee to disclose the expense recognised in the P&L relating to each of short-term leases and leases of low-value assets. One final thing to highlight before getting into the detail on each of the exemptions is that both of these exemptions are optional. Accounting for leases in this way is not a requirement. A lessee can choose to ignore these exemptions and recognise assets and liabilities for all of its leases in accordance with the general requirements in IFRS 16. Starting with the exemption for short-term leases then. In short, this exemption can be applied to any lease with a term of 12 months or less. An important point to note here is that the 12-month threshold relates to lease term as defined in IFRS 16, which isn't necessarily the contractual maximum term. In determining whether a lease qualifies for the short-term exemption, a lessee will need to assess the lease term in accordance with IFRS 16. This means, most notably, that if a contract contains any extension options or break clauses, the lessee will need to apply the reasonably certain assessment criteria in determining the term of the lease. That reasonably certain assessment is similar to that applied today under IAS 17. In other words, the assessment of lease term includes the period covered by any extension options that the lessee is reasonably certain to exercise. Similarly, it includes the lease term covered by any break clauses that the lessee is not reasonably certain to exercise. If that lease term is less than 12 months, then the lease may be within the scope of the short-term lease exemption, subject to a couple of other factors. First, IFRS 16 specifically prohibits a lessee from applying the short-term exemption to any lease that contains a purchase option, even if the lease has a term of under 12 months. Second, the short-term exemption is applied on a class-by-class basis. So, for example, if a lessee applies the exemption to a short-term lease of a photocopier, it would need to apply it to all leases of photocopiers that have a lease term of 12 months or less. Conversely, if it doesn't apply it to one or some of those leases, it couldn't apply it to any of them. So with that summary, perhaps I could come to you now, Sue, and, firstly, ask you to tell us a little about how the board arrived at these particular requirements for the short-term lease exemption and what kind of contracts they had in mind.
Okay, so as I mentioned earlier, we considered different options in arriving at the requirements, and the two exemptions in IFRS 16 are those that we concluded provided the best balance of cost relief for lessees, but without significantly compromising the reported information. I'll talk first about the 12 months element of the exemption. So why did we choose 12 months and not some other time period? And firstly, I think it's fair to say there's really no real magic in 12 months as such. It was really a practical choice on the basis that usually a lease of longer than 12 months is much more likely to give rise to material assets and liabilities than a lease of less than 12 months. In other words, the exemption is limited in this way because the board felt that it would reduce the risk of material information being lost from the financial statements of lessees, but it still provides cost relief for preparers. In terms of how we decided to base the short-term lease definition on the definition of a lease term, this approach means that, practically speaking, a lessee needs to only make one lease term assessment at the beginning of a contract. So a lessee will use the same lease term assessment to either categorise the lease as a short-term lease or, if they conclude that it's not short-term, to measure assets and liabilities arising from the lease. So irrespective of the outcome of the assessment, no further lease term assessment needs to be made at the start of the lease. As to the kind of contracts we had in mind, the simple answer is of course that this exemption could apply to any type of asset, because ultimately the only constraint is lease term. However, in addition to really aiming at leases more likely to have lower amounts associated with them, it's probably worth noting that it's really aimed at simpler leases too. This can be seen in that leases that have purchase options in them cannot qualify for this exemption, as you said before.
Thanks, Sue. On the second point you made about linking the exemption to the definition of lease term, that means that there's some judgment involved here for lessees. In particular, the outcome of a reasonably certain assessment on an extension option or a break clause could affect whether or not a lease qualifies for the short-term exemption. Could you talk about whether the board was concerned at all about the possibility of longer leases being structured to meet the exemption?
And the short answer to that question is yes, we were. And it's certainly something that we discussed when we were determining the requirements. And although the risk of structuring to meet the exemption criteria does exist, the board in the end concluded that this risk should largely be mitigated by the consequences of shortening the lease term from a lessor's point of view. In other words, it would generally not be in a lessor's economic interest to try to offer contract terms to a lessee that are designed really purely for structuring reasons. And let me try to explain what I mean by that. This possibility of using extension or termination options to reduce the lease term below 12 months. So this could be achieved, for example, by having a lease with, say, a 10-year maximum term, but with an initial term of 12 months combined with 9 annual options to extend the lease. In that scenario, if the lessee concludes that it's not reasonably certain to exercise the extension options, the lease term would be 12 months. However, if you think about this from the point of view of the lessor, there would be consequences of providing these kinds of contract terms and flexibility to the lessee. So if I compare a lease with a 10-year committed term to a lease with a 1-year committed term and 9 extension options, the risk from the lessor's perspective are not the same. In the lease with the extension options, the lessor is exposed to a much greater level of residual asset risk than in the lease with a definite 10-year term. Therefore, the board expects that the lessor wouldn't offer such terms without demanding increased lease payments from the lessee to compensate it for that increased risk. Another important factor that we considered relates to the lease term requirements in IFRS 16. So we would expect the rigour that lessees need to apply when determining the lease term reduces the risk of a non-substantive break clause being added to a contract simply to achieve a particular accounting outcome. So one example of this would be a lease that's priced in such a way that a lessee has a clear economic incentive to exercise an extension option. So imagine a 12-month lease with an extension option covering a further 2 years. If the lease payments after the extension were priced at a favourable rate compared to market rates, the lessee would most likely conclude that it's reasonably certain to extend the lease. And in this case, it would need to include the extension period within its assessment of lease term, and so the lease wouldn't qualify for the short-term exemption.
Thanks, Sue. And just to highlight for listeners that the requirements on the determination of lease term will be discussed in detail during the next webcast we plan to provide, which will be on measurements. Now, I'll just mention one final question that we've had on short-term leases before we move on. The question is what happens in the event that a short-term lease is subsequently extended. So, for example, if a lease with a committed term of 12 months and one or more subsequent extension options is initially assessed as being short-term, what then happens if the lessee actually does extend? In terms of what IFRS 16 says on this, there's a couple of things to mention. First, if there is a change in the lease term, which includes things like the exercise of a previously unrecognised extension, then the lessee is required to treat the extension of the lease as a new lease and account for it accordingly. So in the example I mentioned, the lessee would then look at the new extended lease term and apply IFRS 16 to that new lease, which may or may not involve recognising an asset and a liability depending upon whether the new lease term exceeds 12 months. The second thing I'd like to mention here, and it would be good to hear your thoughts on this, Sue, is that the application guidance on lease term in IFRS 16 talks about the fact that a lessee's past practice regarding the period over which it typically uses particular types of assets is relevant to assessing whether a lessee is reasonably certain to exercise an option. That guidance is quite relevant to a scenario involving 12-month options in contracts with a longer maximum term. Perhaps you could talk a little about how and why the board arrived at those requirements and what the practical consequences are.
Okay, so I talked earlier about the rigour that we expect lessees to apply when they determine the lease term, and this piece of application guidance really forms part of that. When we discussed this, the board's overall view was that lease term should reflect the length of time over which a lessee reasonably expects to lease the underlying asset. So when extension options and break clauses in a contract are taken into account, resulting in a shorter IFRS 16 lease term, that should generally be because of genuine flexibility that a lessee has paid for in the contract and that they may make use of when the time comes. Now, the particular requirement that you asked about relates to the relevance of past practice to that assessment and how that might affect a lease that contains 12-month options. And there are, I think, two things to mention on that front. Firstly, if we imagine a lessee that leases lots of a particular type of equipment, so let's say they lease lots of delivery vans, and let's say they always keep each van for around 3 years and then they replace it. Now, if some of those vans are obtained by way of 3-year leases with annual break clauses, in the absence of any new economic factors or significant changes to the lessee's business, that past practice would suggest that it's pretty unlikely that they'll exercise those break clauses. So that would need to be considered. Another way in which this requirement might be relevant is within the context of a single lease. So let's take the lease I talked about earlier, the one with a 1-year committed term that's followed by 9 12-month extension options. So let's say the lessee determines at the start that the lease term is 1 year, but then it subsequently extends the lease for a further year. At that point, the lessee needs to think about why it extended and whether those reasons are likely to also apply to those future extension choices. So whilst the lease might have been classified as short-term at the beginning, there may then be past practice evidence that's available a year later that would suggest that the entity is reasonably certain to use the extension options. This second point really relates to the sub-question on the slide about the possibility of a short-term lease being extended multiple times. In practice, I think it's fair to say we expect it to be extremely rare that a longer lease could retain its short-term classification for any length of time. And that's because the first 1 or 2 extensions are demonstrating that the lessee has an economic reason to extend, and that past practice is really important in effectively assessing whether that lease is indeed a short-term one.
Moving on then to the other recognition exemption in IFRS 16. This one relates to leases of low-value assets. So this exemption can be applied to any lease for which the underlying asset is of low value. This refers to the value of the asset rather than the lease. It is intended to capture the kinds of assets that an entity might lease in large quantities, but that, on an individual basis, are low in value. So things like laptop computers and telephones. In a moment, I'll ask Sue to talk more about what low value means. Just to note first, though, that IFRS 16 requires the assessment of whether or not an asset is of low value to be made based on the value of the underlying asset when it is new, regardless of the age of the asset being leased. The second thing to note is that the assessment of whether or not an underlying asset is of low value must be made on an absolute basis. Put another way, the materiality of that asset to the reporting entity doesn't matter, and the size of the reporting entity doesn't affect the assessment of whether a particular underlying asset is of low value. Finally, in contrast to the short-term lease exemption, the low-value asset exemption can be applied on a lease-by-lease basis. So, if I could come to you now, Sue, could you start by expanding on the term low value? What did the board have in mind here?
Okay, so this exemption is a direct response to the concerns that were raised by lessees about the costs of recognising assets and liabilities for leases that are high in volume and low in value. And it also arguably reflects, I think, the objective of the project. If you've heard board members talking about it, you've probably heard us talking about putting leases of planes on the balance sheet, and you probably haven't heard us talking about leases of mobile phones. Anyway, however, as many listeners will be aware, defining what is low value is a difficult thing to do. And in particular, it's difficult to make it easy to apply in practice while also avoiding capturing leases that investors would in fact want to see on the balance sheet. So we had to do a lot of research on how best to do this before we wrote the IFRS 16 requirements on leases of low value assets. In light of that research, IFRS 16 and the associated documents contain detailed requirements, application guidance, and also an illustrative example on this topic to help lessees to apply this exemption. There is a list of examples of the kind of assets that the board had in mind, things like tablets and personal computers, small items of office furniture and telephones. However, it's of course going to be the case that the kinds of assets that companies use will inevitably change over time. So for example, if we'd had this discussion 15 years ago, we wouldn't have been talking about tablet computers. It wouldn't have been an example that the board would have considered. So we haven't limited just to things that we've put on the list. So we also discussed the underlying reasons for why those kinds of assets are considered to be low value. And ultimately, the view of the board was that the kind of order of magnitude of assets we had in mind when we were thinking about this exemption when we discussed it in 2015 were assets that, when new, had a value in the region of about $5,000 or less.
Thanks, Sue. And as listeners may be aware, this amount of $5,000 does appear in the basis for conclusions. Some have asked about whether this is a hard threshold, i.e. whether it's the case that an asset with a value of $4,999 would be low value, whilst one of $5,001 wouldn't be. Could you talk about that?
Yes, I can. And no, it isn't a hard threshold. It's not a bright line. The first thing to highlight here is that the amount of $5,000 doesn't appear in the standard itself. It's only in the basis for conclusions. And there's a very specific reason for that. So I just talked about the fact that the example of tablet computers and the fact that we wouldn't have talked about those if we'd been writing the exemption a number of years ago. The same will more than likely be true of new assets that currently we're not aware of. So it's not really possible to give a comprehensive list of low-value asset types that will be useful in the long term. So we needed another way to help describe what we had in mind. On a related note, there's inflation to think about. So for example, the board is of the view that individual telephones would reasonably be classified as low-value assets, but it's not possible to know what a telephone's value will be in 10 or 20 years' time. So giving a hard threshold in the standard would also not be helpful in the long term. And so the $5,000 is intended to explain in a straightforward, sort of practical way the sort of assets that the board had in mind as being low value at the time of making the exemption. It gives context that we hope assists people in application, but it shouldn't be considered to be a bright line.
Another question we've had is about materiality. The significance of assets with a value in the order of magnitude of $5,000 will be very different to the financial statements of different sized entities. Is it really the case that lessees should effectively ignore materiality here?
And the short answer to that is yes. This is an exemption for leases of assets with a value of roughly this amount, and it's unrelated to the size of the entity making the assessment. So in other words, different entities would be expected to reach the same conclusion as to whether a particular underlying asset is of low value, irrespective of the entity's size. In effect, the outcome of the assessment has nothing to do with the entity that's making it.
So taking the two ends of the scale here, it must be possible that the low value exemption will be of little use to a large entity because the assets captured will be immaterial anyway. And at the other end of the scale, was the board concerned about the exemption excluding material assets and liabilities for smaller companies?
On the first point, it's true that this exemption is expected to provide the greatest cost relief for smaller entities. So, as you sort of intimate, some of the larger companies we spoke to during our research noted that the exemption wouldn't capture any leased assets that they wouldn't already eliminate using their existing capitalisation thresholds. So the low-value asset exemption works in a similar way to the practical property, plant and equipment or PPE threshold that some companies apply today. So for companies who already apply a threshold for materiality reasons that's higher than the value of a low-value asset as we've described it, the exemption won't make a difference, and they may choose, in fact, not to use it at all. However, for the avoidance of doubt, companies with higher materiality levels are not permitted to use a different assessment of low value that would capture more assets. Low value, as we've said, is the same for everybody. Now, on the second point, the small companies, yes, we certainly did consider the risk of the exemption, capturing assets that are material in the aggregate for small companies. And we identified that this was most likely in service-type businesses that aren't capital-intensive, but may have lots of low-value assets, such as laptops, for example. However, we didn't come across any examples of actual companies in our research for which the aggregate of their low-value asset leases would be material to their financial statements. And obviously that doesn't mean it will never happen, but it does support our expectation that it's going to be quite rare. It does mean for smaller companies, by using this exemption, they don't need to separately consider the materiality for these leases when preparing their financial statements. So I think it provides real relief. We also talked to a number of investors about potentially exempting these leases. And as one investor said, if those kinds of assets are material to PP&E, PPE isn't going to be material to the financial statements. So in short, these investors weren't concerned about the kinds of assets and liabilities that the low value exemption is designed to eliminate. So overall, we concluded that the exemption passed this cost-benefit assessment, including for smaller companies. So really, I guess the practical point to take away here is that the exemption is unrelated to materiality. Companies do not need to consider materiality when they apply it.
Now, as well as the standard itself and the basis for conclusions, there's also the IFRS 16 application guidance and illustrative examples, both of which contain further information on the low value asset exemption. This slide summarises some of the particular things that are specified as not being captured by the low value exemption. I'll run through those and we'll talk about the implementation questions we've had in this area. So we'll start with two fairly similar concepts. Firstly, assets that are highly dependent on or interrelated with other assets. And secondly, assets that cannot be used on their own or that need to be used together with other resources that are readily available to the lessee. Any lease of an underlying asset that falls into one of those categories is not eligible for the low value exemption. Could you talk about that a little, Sue, and perhaps give some practical examples of what the board had in mind?
Okay, so these requirements relate primarily to scenarios in which a lessee might lease a large asset that's made up of a number of small leases of components. And a good example of this is an IT storage system. So we came across cases where a company might initially need only a very small storage device that could be a low-value asset. And over time, more and more storage capacity is leased on a piecemeal basis, and in some cases, each individual lease would be, in isolation, a low-value asset. However, these individual leases ultimately all contribute to the one overall large asset. And in this kind of scenario, those smaller individual leases of storage capacity are prohibited from being classified as low value. Another example which we've been asked about is whether a lessee could lease, say, a car, but do it with different parts being subject to individual contracts. So could a company, for example, have 4 separate leases for the individual wheels on the car, each of which would be low value? And the answer to that question is no. In this case, those wheels are only useful if you attach them to the rest of the car. So they cannot be considered for the low value exemption on an individual basis. So next, the standard prohibits a lessee from classifying a lease that is or is expected to become the head lease in a sublease arrangement as a lease of a low value asset. Now that one's fairly self-explanatory. IFRS 16 requires the lessor in a sublease to classify the lease based on the right of use asset on its balance sheet. If the low value exemption were taken, there would be no asset with which to make that assessment, and therefore some potentially odd accounting consequences. Finally, the standard prohibits leases from being leases of low value assets if the value of the underlying asset is typically not low. Could you expand on that one a bit, Sue? Yeah, sure. So this part of the requirements is related to the fact that there are some types of assets that might vary in value when they're new, but that typically do not fall within the order of magnitude that the board was thinking about with this exemption that we were talking about earlier. So perhaps, I think in practice, the best practical example of this is cars. So there might be some examples of cars in the world that will be of low value when new, using that sort of $5,000 indicator. But typically a new car will be worth more than $5,000. So the low value exemption cannot be applied to cars because of that sort of typical value of a car.
Okay, moving on then to one final implementation question that we've had. This is about master lease agreements. For this one, let's take a particular example. Say a company enters into a master lease agreement with a supplier for 200 laptops, each of which is individually low value, applying all of the relevant criteria in IFRS 16. The question that's been raised is whether a lessee could apply the low value asset exemption to all of these laptops. What are your thoughts on this, Sue?
Well, if the arrangement in substance represents 200 individual laptop leases, then yes, the low value asset exemption could be applied. We've come across the term master lease agreement being used in different ways, but examples of when the low value exemption might be applied is if the master lease agreement is an umbrella agreement with individual contracts underneath it for each laptop, or if the master lease agreement contains, say, an appendix that specifically identifies each asset that's being leased. Essentially, whatever the legal form, if the arrangement is in substance identical to 200 low-value laptop leases, then the exemption could be applied in those circumstances.
I think the alternative view that's been suggested here is that because there may only be one legal contract, all 200 laptops would need to be treated as one lease. Do you think there are circumstances where this approach would need to be taken?
As with all contracts, the individual terms and conditions obviously need to be considered for each of the master leases. And what matters when you think about how to approach this is the substance of the arrangement and not whether it's called master lease or something else, at the top of the contract. So if the contract genuinely provides the right to use 200 individual laptops that each meet the criteria to be of low value, then the exemption would apply. But now, let's think about the alternative scenario. So when would a company need to account for this as one big lease and thus eliminate the possibility of using the low value exemption? That would be the case if the substance of the arrangement was such that different individual lease components could not be identified within that overall arrangement. So for example, this might be the case if the lessee needs all 200 laptops together in order to be able to use and obtain benefits from them. So in this scenario, it's unlikely that each laptop would be a separate lease component. This concept is similar to the guidance in IFRS 16 on separating components of a contract.
So we've now talked through the two recognition exemptions in IFRS 16 in some detail and also looked at implementation questions that have arisen in this area. Is there anything you'd like to add in summary before we end the session?
I guess I'd just like to reiterate that these two exemptions are intended to provide cost relief to lessees without substantially compromising the information that's provided to the users of financial statements. We have, I think, necessarily gone into some detail today about examples that won't qualify for the exemptions because they provide good context to explain the requirements in the standard. We expect the exemptions to be applied to the small, simple leases that are not significant to a lessee's business, and at a practical level would really, if ever, I guess, expect them to be relevant to leases that are lengthy or complex in their terms, or where the lessee has an interest in the residual asset.
Thanks very much, Sue. Now this final slide notes a couple of links to further information that can be found on our website. The second link, which is to the Leases implementation page, summarises all of the work that the board is doing to support implementation. Within that, there's some information about the rest of this webcast series. Links to previous webcasts and the list of upcoming webcasts can be found by following that link. We thank you for listening to our webcast and hope that it was helpful.